The bet that looked safe until it wasn't. For years, it felt invisible, quiet, almost boring. The kind of decision nobody questioned because nothing ever went wrong until suddenly it did. To understand why this kind of bet still happens today, we need to step back, not to a single company or a single trade, but to a mindset, because the same logic that once felt responsible still shapes portfolios now. In investing, safety is rarely announced with excitement. It arrives disguised as stability, steady returns, predictable cash flows, familiar structures. Over time, repetition builds trust, and trust slowly turns into confidence. Institutions leaned into what worked before. Pension funds favored assets that matched long-term promises. Banks structure exposure around models that assume continuity. Investors weren't chasing miracles. They were avoiding surprises. At first, the bet seemed disciplined. Risk was spread. Volatility appeared contained. Historical data confirmed the strategy again and again. Every year that passed without incident reinforced the belief. But beneath the surface, conditions were shifting. Markets were becoming faster. Leverage was quietly increasing. Liquidity depended more on assumptions and guarantees. The structure held because everyone believed it would. Prices reflected calm, not resilience. Risk wasn't gone. It was simply hidden by consistency. What made this bet feel safe wasn't protection. It was familiarity. The same patterns repeated long enough to feel permanent. Early warnings existed, but they were subtle. Small dislocations brushed aside as temporary. Minor stresses explained away as noise. Nothing dramatic enough to force a rethink. And so the exposure grew. Positions expanded. Dependencies multiplied, all while the story remained the same. This wasn't recklessness. It was rational behavior inside a trusted framework, a framework built on the past. But markets don't break because of one bad decision. They break when too many good decisions rely on the same assumption. When safety is defined by history, not structure, the bet didn't look risky. It looked responsible, and that was a problem. Because when the environment finally changed, there was no margin left for error, only realization. When the first cracks appeared, they didn't feel like warnings. They felt like inconveniences. A delayed settlement here, a slightly wider spread there, small enough to ignore. The system had absorbed shocks before. Short disruptions were normal. Markets corrected, stabilized, and moved on. That memory shaped every response. What mattered most was continuity. As long as prices moved, liquidity was assumed. As long as models produced outputs, risk felt measured. The machinery kept running. But liquidity is not a constant. It is a behavior. It exists only when participants believe they can exit. As positions grew larger, exits became narrower. The same assets were held by the same types of investors. Everyone relied on the same assumptions. Everyone planned to sell to someone else. Early sellers found buyers. That reinforced confidence. Nothing seemed broken yet. Then volume thinned. Prices moved faster than expected. What once traded smoothly began to hesitate. Margin requirements adjusted. Risk departments recalibrated. Still, the narrative held. This was temporary. This was manageable. What few noticed was how tightly coupled everything had become. Funding depended on asset values. Asset values depended on confidence. Confidence depended on stability. Each component worked. The system as a whole did not. As volatility increased, hedges behaved differently. Correlations shifted. Protection that worked in the past softened instead of shielding. Models responded with higher risk readings. But models look backward first. They react after the environment has already changed. Decision makers face a dilemma: reduce exposure and confirm fear, or hold steady and trust recovery. Most chose to wait, not out of denial, but logic. Selling into uncertainty felt worse than enduring it, but time was no longer neutral. Every hour altered positioning. Every move tightened constraints. What once felt diversified now moved together. Assets separated by strategy began sharing the same fate. The illusion of independence faded. This was the moment the bet stopped being passive. It demanded action, and action carried consequences. Because when everyone realizes risk at the same time, there is no safe direction to move. Pressure transformed decision-making. What had been theoretical became immediate. Choices were no longer about optimization, but survival. As prices slid, leverage amplified every move. Losses accelerated faster than forecasts predicted, not because the assets were worthless, but because they were held the same way. Calls came in rapid succession. Collateral needed adjustment. Timelines compressed. What once took weeks now unfolded in hours. Institutions discovered the cost of synchronization. When everyone manages risk identically, risk stops dispersing. It concentrates. Selling begot selling, not from panic, but obligation. Risk limits triggered. Contracts enforced terms without emotion. Attempts to rebalance only deepen the strain. Markets absorbed less with each transaction. Liquidity evaporated in layers, not all at once. Confidence fractured unevenly. Some believed recovery was imminent. Others saw a structural shift. That disagreement widened spreads further. At the core was a simple truth. The bet assumed continuity. But continuity had already ended. Hedging strategies collided. What offset risk in isolation failed in aggregation. Protection became correlation. Diversification collapsed into sameness. Capital that once flowed freely reversed direction. Funding tightened. Access narrowed. Flexibility disappeared. Every participant acted rationally. Every response made sense locally. Together, they created instability. This is how pressure reshapes markets. Not through chaos, but alignment. When incentives converge, outcomes compound. The system didn't collapse from ignorance. It strained under intelligence. From models too similar. From strategies too aligned. And then came the realization. There was no external shock left to blame. The structure itself was the stress. The bet was no longer about returns. It was about exit. And exits had become scarce. In that moment, the true risk surfaced. Not volatility, not valuation, but dependence. Dependence on assumptions that no longer held. Dependence on behavior that had already changed. Dependence on a past that could not return. The climb toward stability now required something different. Not confidence, but acceptance. Stability did not return with dramatic reversal. It arrived quietly, through smaller positions, through wider margins, through humility replacing certainty. The climax wasn't a crash. It was recognition. The moment investors understood that safety had been misdefined. What failed wasn't intelligence. It was alignment. Too many decisions built on the same logic. Too much trust placed in historical calm. The market didn't punish risk-taking. It punished sameness. In the aftermath, portfolios were rebuilt differently. Not around optimization, but resilience. Liquidity was treated as a resource, not an assumption. Stress scenarios stopped being abstract. This story matters because it keeps repeating. The structures change. The instruments evolve. But the behavior remains familiar. Periods of stability invite concentration. Success encourages replication. And eventually, safety becomes crowded. The lesson is not to avoid confidence. It is to question what confidence is built on, to separate familiarity from protection, to understand that the greatest risk often hides inside agreement. Every cycle leaves behind data, but it also leaves behind habits. And habits shape the next decision long before the next crisis appears. What looked safe was never fragile by itself. It became fragile because everyone believed the same thing, at the same time, for too long. Markets don't break when people are wrong. They break when everyone is right together. And that is why this story isn't finished. Because the next version is already forming. Quietly, in plain sight. The bet